Impairment, it's a totally different approach. Hedge accounting, slight changes, nothing in depth except for some rules, especially 8120. I will not focus a lot on hedge accounting after I discover your background. Let's focus on the main two things, which is classification and measurement, as well as impairment. So, IFRS 9 replaces IAS 39. How many financial asset categories we used to have under IAS 39? An idea? What the categories that we used to have? Trading, no, fair value P&L, held to maturity, available for sale, and loans and advances. True? We had 4 categories under IAS 39. Trading, which is a trading book, available for sale, held to maturity, and loans and advances to loans and receivables. Sorry. How we use to classify a financial asset? Let's say if I have a trade receiver or if I have a debt instrument. How usually companies, management, ALCO committees, investment committees used to classify their financial assets? What was the criteria? What was the basis? So if I want to classify a financial asset or a debt security as held to maturity, what was the idea or the criteria used? Intention and ability. True? It was intention and ability to hold this financial asset to maturity. Yes. That was the criteria to classify a financial asset as held to maturity. Intention and ability. Okay. What was the criteria to classify a financial asset as trading? Excuse me? Yes?
Trading, if it's a part of the operating activities, inventory, moving around.
Trading portfolio. Okay, to get the short-term gain or losses from the market fluctuation. That was for trading. Okay, what was the criteria to classify as available for sale?
Within 1 year.
Sorry?
Within 1 year.
Within 1 year? What's within 1 year? The maturity?
Maturity.
Okay. Any other idea? In fact, there was no criteria. So once the accountants, the financial controllers, or the investment committee does not know what to do with this financial asset, they used to put it by default as available. Okay, this is the safest place, let's park it in there. Okay? So, why? Because they can put it at fair value, and the change in fair value will go to other comprehensive income. It will not impact the P&L. And once they sell it, they just recycle the change in fair value from the other comprehensive income to the P&L. Okay? So there was no rationale in how to classify a financial asset as available for sale. So, and loans and receivables, here we are talking about your trade receivables, or we are talking about the loan book that usually banks have. So that's the loans and receivables. This concept is completely unused anymore. Okay, so all this concept of intention, of ability, has changed completely. Yes, we still have some kind of securities that have the same characteristics. So under IFRS 9, we have 3 main categories. Instead of 4 categories under IAS 39, we have 3 categories under IFRS 9. Assets that are classified at fair value through P&L, assets that are classified at fair value through other comprehensive income, and financial assets that are classified at amortized cost. Okay? So this is the first change from IAS 39, in which we used to have 4 categories. Now under IFRS 9 we have 3 categories. Fair value to P&L, fair value to OCI, and amortized cost. Okay? So 3 categories. The second change is, on what basis can I classify a financial asset as fair value through P&L, fair value through OCI, and amortized cost? Any ideas? What's the new basis now?
Business model.
Business model. What do you mean by business model?
How the company is managing.
How the company manages this financial asset. Okay? So what's the objective of the management when they purchase this financial asset? What was the objective of purchasing this investment? Is it to collect cash flows? Is it to sell it? Or both? Okay? So this is one of the new concepts, which is the business model, in which we talk about the objectives of the management that should be documented in a policy, that this is the policy that applies to this portfolio or to this financial asset. Business model. What's the other criteria that we look at?
Cash flows.
Cash flows. What do you mean by cash flows?
If it's contractual or
If it is contractual or long term. What do you mean by long term? An idea. So there is cash flows, but what do you mean exactly by cash flows?
If the cash flow is solely for payment of principal.
Solely payment of principal and interest. Okay, this is absolutely key. So we talked about two. So, two things to look at. The characteristics of the cash flows and the business model. These are the two criteria that going forward, actually from January 1, 2018 and going forward, that will determine how to classify a financial asset at initial recognition and then subsequently. Okay? So, what are the two criteria? First one is the business model. What's the objective of classifying this financial asset, or the objective from buying this financial asset, and how management would like to manage its portfolio of financial assets. The second criteria is, does the asset by itself, are the cash flows from this asset, meet the definition of a what we call as SPPI, solely payment of principal and interest. Let me explain this concept. What do we mean by solely payment of principal and interest? Let's say I buy a bond, a debt security, a bond, for 1 million dirhams, and the interest rate is 5%. That's paid every 6 months. Okay? So every 6 months, I'm expecting to collect what? The interest. True? And at maturity, I'm expecting to collect the principal. If the objective of the company is only to collect the cash flows, which is the principal and the interest, then this company can classify this financial asset at amortized cost, with the objective only to help to collect cash flows, not to sell, only help to collect. This is for the objective. For the SPPI, okay, these cash flows that I'm getting from this financial asset are in fact what? Are in fact interest and repayment of principal. So 5% is a market rate for interest that includes several kind of risks, credit risk, market risk, as well as some reasonable profit margin. Okay, so all this is embedded or factored in this 5%, let's say, plus the principal at the end or at maturity. So the cash flows that I'm collecting are in substance only collection of interest and principal. So this bond or this financial asset needs the definition of SPPI or meet the characteristics of SPPI. If I have both, if I have a business model which is held to collect and the asset by itself meets the criteria of SPPI, this asset should be classified at amortized cost. It's no more intention, no more ability. If it meets both criteria, this asset should be classified at amortized cost. This same bond that meets the SPPI test But the objective of the company is either to collect cash flows or to sell. So let's say this bond is a 10 years bond. The company's objective or business model is, okay, I'll collect the interest up to 5 years and then I will sell it. So what's this business model? It is a held to collect and sell. Okay? If I have such business model and the asset meets the SPPI test, this asset should be classified as fair value to other comprehensive income. Okay? Again, it's not an intention, not ability, and not a default classification as available for sale. So fair value to OCI is not the same as available for sale under IAS 39, just because the change in fair value goes to equity. It's totally different treatment, different basis on how to classify a financial asset. The default classification is now fair value to P&L. If I don't know what will I do with this financial asset, it's now you have to classify your financial asset at fair value to P&L, not available for sale, which was in equity. So the default classification is fair value to P&L. In other words, fair value to P&L includes two kinds of portfolios. It will include your trading book, which is fair value to P&L, and will include any debt or equity securities that does not meet the SPPI test or does not fall within a business model of held to collect. Is that clear? Any questions so far? So, just in summary, these are the three kinds of classifications that we have: amortized cost, fair value to OCI, and fair value to P&L. Two things that we need to look at: the business model, which is held to collect and sell or only sell, and the characteristics of the cash flows from this financial asset. Do they meet the SPPI test or not? Okay? So these are the kind of questions that a company, a financial controller, accounting department, investment committee that has to ask to identify in which category this financial asset should be classified. So, is it within a business model to collect or sell? This is very, very, very important. And trust me, this is, if you look at face value, you think it's easy. But look at a bank portfolio that might have hundreds or thousands of securities, debt, especially debt securities. Maybe the same security, he might have 4 or 5 bonds from the same issuer. He may need to classify part of it at amortized cost and part of it at fair value to OCI. And there is a huge difference in treatment subsequently. So it's not only at initial recognition. So at initial recognition, I will determine, okay, these 5 investment securities, I will put them at amortized cost. And these other 5, I will put them at fair value to OCI. This is at day 1, it's easy. But day 2, what I have at fair value to OCI, I need to fair value. I should always book them at market value, and the change in fair value will go to equity. However, for the financial assets that are classified at amortized cost, I should carry them at carrying value, but they are subject to the impairment methodology. Okay? Even in debt securities, the fair value to OCI are subject to impairment, but the impairment amount is not reflected in the face value of the financial asset. Okay? I want to start on the performance. This also will help to understand whether this financial asset should be classified at amortized cost or at fair value. For example, if I have a fund, and this fund usually, all mutual funds or funds, they mark to market their NAV every month. So such kind of securities that are within this fund they cannot accept to be at fair value through P&L, because here the objective is just mark to market and to increase or to account for the change in fair value and pay the returns based on this change in fair value. And even the compensation of the fund manager is based on the NAV or the market value. So these things we should weigh properly to make sure that which business model applies for these financial assets. In case of companies, so you may ask, okay, what will be the impact on trade receivables that we have in our book? Okay, what do you think? Trade receivables, what's the business model for trade receivables? Is it to sell, to carry it to maturity, or what could be the business model? It's to collect. Okay. And this is maybe in the 90% of the cases that yes, you hold your receivables to collect based on the credit terms that you have. 30 days, 60 days, 45 days, whatever. So your business model is to collect your receivables. But some companies would like to sell their receivables, factoring or securitization, right? So, and some companies might have both models. Some kind of trade receivables they want to collect, and others they want just to discount or to sell to with recourse or without recourse. True? So, previously, if I have a trade receivable that was factored without recourse, it was still in my books. I would not recognize it, right? So, but I don't bother to fair value. It's still at cost. Here is the change. So if I have trade receivables that are in a business model to sell, I need to fair value these receivables. I cannot keep them at the carrying amount or the invoice amount. This is one of the big changes that IFRS 9 would impact. And again, trust me, you will face this thing, especially if the factoring is there. If the factoring, the securitization is there, then you need to think about different business model and how to fair value a financial asset. Okay. So we talked about the business models now. Okay, how to collect or to sell, whether in a bank or whether in a corporate. For the SPPI test, it's absolutely important. It's absolutely important to assess the characteristic of the return that you are getting from a financial asset. So we usually know about the interest, right? That interest is the return. How do we define interest? What is the characteristics of interest? How do banks calculate interest? When you go to have a loan, they give you 3 or 4 or 5%. Usually, what does this percentage reflect?
It's the nominal interest.
It's nominal interest. Okay. What does this interest include? How do they price?
Based on market.
Mostly with the
Market,
lending rates.
Borrowing cost.
Borrowing rate.
borrowing rate. But what does this borrowing rate include?
Interbanking system borrowing rate.
Interbank sometimes. But basically, what does it include? When we say interest, what should it reflect?
Risk.
Risk?
Yeah.
The time,
Time?
the rate.
Okay. And, sorry? Inflation? Somebody else? Okay. Perfect. So any interest rate, whether it is for a loan or for a debt secured, I mean by a bond, the interest components are credit risk, time value of money, market risk, and the profit margin. So when a bank prices a loan, usually they look at these things. Okay, what's the interbank rate, and then they start building up. Okay, what's the credit risk? Okay, I put, let's say 0.5%. What's the profit margin I want? I put 1%. Okay? So if the interest rate or the return is only in substance interest, then the SPPI test is met. But let's say if I have a convertible bond, if a company is holding a convertible bond, the return of this convertible bond, does it only include interest? No. Why? Because there is a conversion option. There's a conversion option that the investor has paid for to convert this bond to shares. This conversion, it does not meet the definition of interest. So any company that's holding now a convertible bond, it cannot accept to record this bond at fair value per P&L. So a convertible bond previously, I could have it as held to maturity and measured at amortized cost. Now, convertible bond, it cannot be except fair value to P&L. Okay? Let's give another example. I may have a debt instrument, and usually when we talk about classification of amortized cost, we are not talking about shares. A share cannot be at amortized cost. Okay? It can be, I will discuss in more details about shares. So if I have a bond whose rate is linked to a market index, let's say to the Euro USD rate or to the inflation rate. Okay? Such kind of securities we have to assess properly. So the returns here are not in fact due to time value of money, due to credit risk. It's linked to different commodity. And this kind of security cannot be classified at amortized cost because it does not meet the SPPI test. And it cannot be classified at fair value to OCI also. So once it's faced the SPPI test, it cannot be except fair value to P&L. That's why these are the features that we need to assess properly for each financial asset. And we've seen that a lot in the market, especially convertible bond, especially credit-linked notes, and some of the Islamic products that didn't meet the SPPI test. Even the prepayment and the extension options. So sometimes I have a prepayment option to pay this debt in advance. If the prepayment only includes the interest and some reasonable penalty because I'm prepaying, it's fine. This asset meets the SPPI test. But if it is beyond that, it cannot beat the SPPI test. If I'm paying in advance the interest, it's fine. But the interest up to the date of prepayment, it cannot be the interest for the whole life of the asset. If it is for the whole life of the asset, it fails the SPPI test. Because why? It does not meet the time value of money classification or component of the interest. So prepayment, we should assess. Extended options also we should assess in the same concept. So this is for debt instruments. For equity instruments, we have two classifications. Either fair value to OCI or fair value to P&L. We have an irrevocable option at day one to classify a financial asset, equity, at fair value to OCI. It is just at date of initial application or at the date of purchase of this financial asset. There is an irrevocable option to record it at fair value to OCI. Otherwise, it should only be fair value to P&L. What's the impact? If I record an asset at fair value to OCI, I need to fair value it. There's no cost exemption. So previously, I could have a available for sale asset, but I say, okay, it's fair value. It's almost the cost. So we and companies didn't fair value this asset. This is no more an option. Each fair value of OCI should be remeasured and a fair value should be calculated for it. This is one. And the change in fair value of this financial asset, it goes to OCI. Okay? If I sell this asset, if I sell this equity share, previously we used to recycle the change in fair value from equity to P&L. Currently, under IFRS 9, if I have an asset at fair value to OCI, I cannot recycle the change in fair value from equity to P&L on the sale. I'll just take it from OCI reserve and put it as retained earnings. This is a major change which companies need to think about at day one of classification. That, okay, if I have a gain, this gain will not be reflected in P&L when I sell this asset. Why? The standard setters want only to see as fair value through OCI as just strategic investments. They don't want to see assets that we used to see under available for sale classification. Okay? Any question? This is everything about classification and measurement before we move to the impairment. It's fine? For financial liabilities, there is no change in classification. The same guidance is still there under IAS 39 and IFRS 9. The only change that if I have an asset measured at fair value, the change in the credit risk of this financial asset can be classified at OCI, and the remaining can go to P&L, while previously all the change in fair value used to be in P&L. We rarely see these kind of securities, but this is the main change between IFRS 9 and IAS 39. Impairment. Here is the hub of the changes. Okay? So what's the main change between the previous standard and the new standard? An idea? From the incurred loss model to the expected credit loss model. It's only a few words, but it means a lot. It means a lot. Okay? So under IAS 39, I used to wait for an asset, for a financial asset. If it is in default, I start recording a provision. Okay? Now, at day one, once I have an asset, okay, I should record a provision for expected credit loss. Okay, this is the main change. Why? It's again, they want companies to anticipate, to have some forward-looking information, and to include this forward-looking information in their balance sheet today, so that once we have default, the amount of provision will be manageable. We will not have again this domino effect that we see, or that we used to see under the previous standard. Okay? Does this mean that this is more conservative? It looks conservative, but under IFRS 9, we should not be conservative. We should take the probabilities of all possible events. So when I say expected credit loss, I should take the probability that the loss will happen and the probability that the loss will not happen. And they should be equal. I should have both sides. I should not be conservative that I put some more weights on that the loss will happen more than the loss will not happen. So there should not be a bias. It's an unbiased approach. It just should be based on some forward-looking information having the probability of default as weights. I will discuss this in more details, but because usually when we say it is expected credit loss, just people say, okay, it's back to conservatism. No, it's not about conservatism. And I can tell you that I saw a lot during this year where many companies used to have higher provision than what IFRS 9 is requesting. Even banks. Some banks, especially those that have mortgage loans, only mortgage loans, so the expected credit loss is low because they can acquire the real estate mortgage, okay, and which fair value maybe is much more than the exposure that they have. So, and under the central bank, they have a regulation that they have to have a minimum of 1.5% as a collective provision. So, the amount of provision that they used to have under the previous standard plus the regulatory provision were higher than what is requested under IFRS 9. So it's not a conservative approach, it's just a new approach with different ways to approach or to calculate the expected credit loss. So, are all financial assets should be tested for impairment? No. Equity securities are not tested for impairment under IFRS 9. Because why? They are already measured at fair value. So equity securities is out of the scope of the impairment of IFRS 9. Okay? Even debt securities that are classified at fair value to P&L, they are not subject to the impairment model because they are already at fair value and the fair value is in P&L. The only two types of financial assets that should be tested for the impairment under expected credit loss are the amortized cost securities and the fair value through other comprehensive income securities. The debt securities that are either at amortized cost or at fair value through OCI. So let's discuss this methodology. When we say expected credit loss, okay, how can I anticipate? How can I calculate? So there is two approaches. We have the general approach in the calculation and we have the simplified approach in the calculation. Banks have to use the general approach. Even if I have an asset with a significant financing component, companies have the option to use the general approach or the simplified approach. But what's the general approach? The general approach says that I have financial assets that sits in three different categories or three different stages. Stage 1, Stage 2, and Stage 3. What is the Stage 3? Stage 3 represents the assets that are in default. So, if you are in a corporate and you have receivables that are 360 days past due, most probably these are what? In default. So, such kind of assets that used to be in default under IAS 39 are now Stage 3 under IFRS 9. So there's no major change. In a bank example, all loans that are non-performing and in default are a Stage 3 loans. The issue is here in the Stage 1 and the Stage 2. Actually, it's not appearing, but fine. So, Stage 1 and Stage 2. What is the difference between a Stage 1 loan and a Stage 2 loan? Any idea? Fine. I will start with an example of a bank and then we'll go into different examples. Let's say today I go to a bank and I ask for a personal loan. Okay? And if you are a corporate, let's say today you go to a bank and ask for a overdraft facility. Okay? This is the first time that your company deals with EIBD, with FAB, with whatever bank. Okay? At day one, they will give you a facility of, let's say, 5 or 10 million dirhams, whatever facility you are asking for. At day one, you are a Stage 1 loan. Okay, you are a Stage 1 loan. Next year, the bank will ask for your financial statements. True? That's what they usually do. They ask for financial statements. They do again their analysis. Let's say at the date of initiation, which was today, they will do some ratings. They will rate you, let's say from 1 to 10. 10 is very bad and 1 you are excellent. They gave you a rate of 4, which is very good. Your company is rated 4, which is very good, which is low credit risk. Next year, things in your company happen negatively. You have negative cash flows, you have some negative profitability. Things changed. And instead of getting a rate of 4, your company now is getting a rate of 6. Okay? So what do we have here? We have what we call a credit risk deterioration. Credit risk deterioration. Going from 4 to 6, if this is considered, based on the bank's policy, if going from 4 to 6 is considered a significant increase in credit risk, then this loan will move from stage 1 to stage 2. Okay? So you are still performing, you are still paying your interest, you are still paying the amount of, or the installments that you have, but instead of being a stage 1 loan, now you are a stage 2 loan. What does this mean? That the credit risk is higher, is significantly higher from the date of initiation. From the date of initiation. So if initiations happened 10 years back, I should always be comparing to the initiation. In this example, I said it's only 1 year because it started today. And after 1 year, we are comparing with today. But if this loan started in 2015, I should compare the credit risk today with the credit risk in 2015. And if there is a significant increase in credit risk, this loan will move from stage 1 loan to stage 2 loan. What will be the impact? For stage 1 loan, I should account for the expected credit losses, right? But the expected credit losses are only for the 12 months expected credit loss. However, for a stage 2 loan, I should account for the lifetime expected credit loss, which are significantly higher than the 12 months expected credit loss. So in other words, let's say you are taking a term loan for 5 years. The company is taking a term loan for 5 years. Looking after a 12 months horizon from now, okay, I can anticipate 3-4 risks. And for these 3-4 risks, I will calculate the expected credit loss based on these expected risks. However, over a 5 years time, the expected losses are definitely higher because they are uncertain. If it is a stage 1 loan, I might take, for a 5 million dirham, I might take 100,000 dirhams as expected credit loss, which is over the next 12 months. But if this is a stage 2 loan, I might take 500,000 because I need to account for the all expected credit losses over the lifetime of the asset. And trust me, that was the main impact that banks had. Because previously, you are either performing or non-performing. You are either paying your interest, even if you are in delay. Okay, you are still paying. They say, okay, we know this customer. This customer has been dealing with us for more than 10, 15 years. He's creditworthy. He's the son of that guy. He's this company. He's backed by the government. All these scenarios, right? So even if you are in delay for 3, 4, 5, 6, even 1 year, the bank is happy because he's getting the interest, he's getting the fees, and he believes that you will pay more or less. Okay? Now, things change. The day you cross the criteria of stage 1, the bank has to bear additional provisions. And that was the main impact why the provisions increased significantly in the banking industry this year. Some banks had more than 15-20% additional provisions due to IFRS now. The good thing that at day 1, all these provisions were reflected in retained earnings, and then it will be reflected in P&L. Is this clear? Moving from stage 1 to stage 2. Is it clear? Okay, so what's the criteria? The criteria is if I have a significant increase in credit risk, this loan will move from stage 1 to stage 2. What do we mean by significant increase in credit risk? We can have some quantitative criteria or some qualitative criteria. Quantitative, as I mentioned, if the rate deteriorated significantly based on internal rating model. Qualitative, let's say I know that this customer is having difficulty in different place. Something happened, for example, let's say if I have a customer and main comes, let's say, from different country that is having issues, big issues, currency issues, different issues, political issues, then this is an indication of the credit deterioration. If I have a loan that moves from stage 1 to stage 2, this does not mean that this loan cannot move back. Okay, I can have a loan moving from stage 1 to stage 2, and then once things change, once his credit worthiness changed or becomes better, I can move this loan from stage 2 to stage 1, and I will do a write back of the provision. Okay? So, what do you mean by 12-month expected credit loss? It is the expected credit losses from all default events that are anticipated in the next 12 months. By lifetime, we're talking about expected credit losses that are anticipated over the life of the asset. However, the amount of expected credit losses to be recorded in the financial statements is the weighted average of all expected credit losses. It's not the optimistic view, it's not the pessimistic view, it is a weighted average of all probabilities of defaults at different points in times. How do we calculate this? I know you are thinking about how do we calculate this. It is not easy. There should be some models. Trust me, it is not easy, especially that now it's not only, okay, we go to the history and we anticipate. Yes, we have to go to the history, but we have to link the history with some macroeconomic scenarios that will impact the future of the provisions. I will discuss this in details in the next slides. Actually, I like about this slide. So this is a quick comparison between how provisions used to be under IAS 39 and IFRS 9. So previously, under incurred loss model, I either have a loan which is performing, and suddenly when this client is in default, I will record full amount of provision. True? However, under IFRS 9, at day 1, I record a small portion. Okay? And then, once I have a significant increase in credit risk, which I mean I move from stage 1 to stage 2, I have additional portion of the provision. And if this loan goes to stage 3 or to default, I record the rest of the amount. So I'm building the blocks of the provision, anticipating that an expected credit loss will happen in the future. Okay. Under the simplified approach, which most of the corporates have done, we don't go through the stage 1 and stage 2, and we don't bother about having a criteria for significant increase in credit risk. We immediately only account for the lifetime expected credit loss. Why? Because in corporates, you don't have basically long-term receivables. So usually are within 1 year, and there will not be a big change from a 12-month expected credit loss with a lifetime expected credit loss. That's why it is a simplified approach. You just calculate a loss rate. A loss rate, which we'll see how there are different scenarios. So the standard do not specify how to calculate. They just give you the principle. And it's up to the company to apply the different methodologies, different models on how to calculate the expected credit loss. This is an example of the loss rate. Okay? So let's say if I have the aging report. Usually, prior to IFRS 9, all the companies have the aging report. This is nothing new. But once, based on internal policy, each company might have different policy than the other. If a loan or if a trade receivable crosses the 90 days, they start recording an amount. Let's say 10%, 15, 20%. And if it crosses the 150 days, it records additional amount. Now, even the current portion even the current portion, you have to assign a loss rate for it. So at the date that I issue the invoice and I record debit receivables, credit revenue, at the same time I have to record debit provision for expected credit loss and credit allowance for expected credit loss. Okay? Interesting, huh? Okay. I don't know how much this applies for the corporates, but usually you should have your default definition. This is the starting point. You should identify the default definition that if it is 90 days, 150, 180 days. The standard talks about two backstops. That if a receivable or a loan or a debt crosses the 90 days, it is a default. 90 days from its due date, not from the invoice date. So if I have the credit terms of 60 days, then 90 days from 60 days, that means 150 days from the invoice days. Okay? So it's 90 days from the due date. At this point in time, as per the standard, this is the backstop that this loan is in default. In case of the banks that or the companies that use the general approach, the 30 days is the backstop for the stage 2. So stage 1, if I have a term loan that is 20 days past due, it's still stage 1. If it is 30 days past due, it moves from stage 1 to stage 2. If it is 90 days past due, it moves to stage 2. These are backstops in the standard which most of the banks and companies had applied. This is what I mentioned before, that the amount of loss should be based on the probability weighted amount that should be unbiased. I should not apply any bias in determining the amount of provisions that should be there. So this is the principle. Now let's come to the calculation, which I think you are thinking about now. How to estimate, how to record, how to measure the amount of expected credit loss. Different factors that we should look at. There's nothing called, this is the only methodology. The standard IFRS 9 does not put a methodology that companies or banks have to apply. It's not there. The principle is there. How to apply it, that's for each company, for each bank by itself. However, these are the guidelines that each company has to assess when they are implementing the IFRS 9 or when they're implementing the expected credit loss model. What are these things? Past events. This is the right thing to start with. History. Historically, we have the chance to collect all of our dues? Yes or no? If no, what's the percentage of collecting? What's the percentage of not collecting? And by history, I'm not talking about 3-4 months. We're talking about 5 years at least to build the history, to build the proper database or data points in order for us to estimate the future. So we look at history, we go by the aging, we check what is the history of defaults, what's the flow rate from one bucket to the other bucket in the previous years. And then also we assess the current conditions, and this is absolutely important, reasonable and supportable forecast of future economic conditions. And here is the game. Here is the game. What do I mean by the game? Previously, I could say, okay, my loss rate is 1%, I will take 1%. Okay? Now, if your historical rate is 1%, you need to match this 1% with economic variables that are linked to the performance of your company, or to the performance actually of your receivables, of your clients. So let's say you are in a business that only sells for oil and gas industry. Okay? You are in a business that only sells, all your clients are in oil and gas industry. And historically, your loss rate was 5%. 5% of my receivables cannot be collected. This does not mean that you should take 5% for the future. Why? Because your client's cash flows, your client's profitability, your client's business is heavily impacted by the oil price. In 2013, 2014 also, the oil price reached $120. In 2016, it reached 55. Okay? So, when I want to look at the forecast, I need to assess what was the impact of this change in the price on the loss rate. I will find a correlation, and then I will look at the estimate of the oil price for the next 3 or 4 years and do my expected credit loss methodology. This is a simple example, theoretically. Practically, it's not easy. You need to find this correlation, you need to prove this correlation, and you'll find the right estimate. There are a lot of models there, we applied a lot of models, but this is the game changer. So each company now should have developed its internal model on how to calculate the expected credit loss based on the new methodology. This is what actually most of the companies applied. Again, it's not in the standard, but this is the main formula that was applied by banks and even by corporates. What is the expected credit loss? It is PD times LGD times EAD. What do you mean by PD? PD is the probability of default. What is the probability that this customer will go into default? This is the first pillar. The second pillar is the LGD, which is loss given default. What does it measure? If this loan wants to default, what is the recovery? So even if I have a customer that crosses the 90 days or the 150 days or the 60 days, but once he crosses the 60 days, sometimes I do some settlements and I can collect 50, 60, 70% of the amount. Okay, so then my loss, if I collect 70%, so what's my loss rate? 30. So this would be my LGD based on my history. Okay? The exposure at default is in fact the amount of receivable, the amount of loan outstanding as of a cut-off date. So this is the formula. How do we calculate the PD? In banks, we have the internal ratings. So for each rating, for each customer, you have a rate. I mentioned, let's say 1, 2, 3, 4, 5, etc. If it is rated 5, the PD might be, let's say, 0.3%. Okay? In corporates, we calculate the PD based on the history of flow rate. How much, historically, how much from your loans, this is what we call as the flow rate model, how much of your receivables moved from the 30 days to the 60 days? Or from the 60 to 90, 90 to 120. Okay? So this will provide us with some probability of default based on your history. Okay? And again, from this history, I need to do the forecast of the probability. That's the historical loss rate. And then I need to add the macroeconomic scenarios that are correlated to this change in the bucket to estimate the probability of default in the future. This is for probability of default. For LGDs, I need to go to see from these loans or receivables that defaulted previously, at least 5 years, how much was the company able to recover? So if I have 1 million dirhams that defaulted, from this 1 million dirham, how much I was able to recover? 200,000, 300, 500, and then I will calculate the rate. The exposure is the exposure. This is the easiest thing. Okay? I believe it's on time. I can see 5 minutes. So this is the theory. I will not go into hedging. I know this is what maybe basically is important for you. I'm happy to listen to your questions, to see what clarification you need, especially on the impairment if you want. Any questions? It's easy. Come on, tell me, what did you do? Yes.
Does ECL apply to intercompany receivables?
Yes. This applies to intercompany receivables, but if you have a consolidation, at consolidation you need to offset it. But actually this is one of the things that we were challenged by different clients. But this does not mean that, so the standard does not differentiate between intercompany or normal receivable, but maybe the loss rate will be less because historically you should not have a default from an intercompany account. But even it applies also to the cash and bank. So this is the other thing that we're challenged at. So even if a company has a deposit at FAB or ENBD or ADCB or whatever bank, they were asking, oh, come on, it is FAB, it is. Even if it is with the bank, you have to account for expected current loss. The amount will be minimal, okay? For the amount of provision will be minimal, but it should be there. There should be some calculation even on these exposures. Yes?
For the rate to be applied on the ECL, is there a standard rate or it will be company management decision?
No, it's not even management decision. Actually, the rates are entity specific. Each entity's performance could be different from its peer, or from its competitor, or from its whatever entity. So there's no standard rate, and this is actually this is an important question because sometimes some companies try to benchmark. There's no benchmark. Maybe the same customer might be paying properly with your company, and he's a default with another company. Okay, so that's why it is an entity specific. This probability of default is entity specific. If you don't have that, and we face this a lot actually, so in case the data was not supporting or not making sense because some companies didn't have the aging for enough period, or even they may have a new company, okay, which they didn't have history of default, okay, then we come up with some benchmarking for the market, then it's fine. But this is the last thing that we look at in specific situations because it is highly challenging. Okay, but it should be how your company, how your portfolio of receivables or of clients are behaving. It's not about how the market is behaving. Any other question?